Welcome to The Explainer. Today, we're diving into a really sobering market analysis from Signal929 for July 22nd. If you've been watching the markets lately and maybe feeling a false sense of security, well, this explainer is going to be a massive wake-up call. We're looking at a market that is currently balancing on a knife's edge. So we're going to use the raw source data to dissect exactly why today's fragile market highs are absolutely not what they seem. Let's jump right in.
Now, on the surface, these recent breakouts might look like a roaring bull market. But if we peel back the layers and look closely at the professional COT data, that's the commitment of traders, it reveals a pretty hidden danger waiting for the emotional public. The professionals are positioning themselves very, very differently than the retail traders who are just out there chasing these highs.
So here's our roadmap for today. First, important risk disclosures. Then, the illusion of strength, followed by the specialist sell trap. And finally, navigating the seasonal bottom.
All right, part one, important risk disclosures.
Before we even look at a single chart, we gotta talk about risk. And I don't just mean skimming the fine print, I mean truly understanding the rules of the game here. This analysis is strictly for educational and informational purposes only. Nothing we're looking at today constitutes a recommendation to buy, sell, or hold any financial instrument. The publishers of this source material, James Goverty and Signal929, are not registered financial advisors, and you are totally responsible for your own investment decisions. We're here today purely to demonstrate market theories and trading concepts.
Because let's face it, trading is highly risky. You can lose all of your initial investment, and honestly, sometimes even more. You should only ever use true risk capital. Money you can afford to lose completely without it altering your lifestyle. Remember, past performance is never a guarantee of future results. And crucially, under CFTC Rule 4.41, any hypothetical or simulated performance results have inherent limitations. They benefit from hindsight and don't represent actual executed trades, which means they might not account for real-world factors like a sudden lack of liquidity.
Okay, moving on to part two, the illusion of strength.
The overarching theme from our source data for July 22nd is pretty stark. The current market state just cannot go on like this. The data notes that major sectors right now are stretched to what it calls gold bond dollars. Basically, that means they're priced for absolute perfection, leaving literally zero room for error. So we need to look at volume divergence. Think about it. Prices are ultimately maintained by the underpinnings of volume. When a market drifts to marginal new intraday highs on a tight daily range and low volume, those underpinnings are weak. They're crumbling. This divergence is basically a blaring siren. It warns that the price structure is highly vulnerable and is going to come tumbling down until volume and price are back in gear.
So, you might be wondering, who exactly is driving this market right now? The data reveals this fascinating tug-of-war going on. On one side, we have the emotional public. They see a marginal new high and rush in, chasing these high-priced breakouts and driving this fragile, low-volume grind. But on the other side, we have the smart money, the professionals. A real sustainable uptrend requires determined professional buying. And guess what? They rarely chase light volume. Instead, they actually use this false strength to quietly exit their positions.
Let's break down the exact evidence of this lack of professional accumulation, because it's all right there. First, look at the daily range. The incredibly tight ranges we're seeing right now show a severe lack of real buying pressure. Second, and this is absolutely crucial, we have Progo divergence. The Progo index is great because it actively separates public buying from professional buying. So when the price makes a marginal new high, but that professional line fails to confirm it, it proves the pros are quietly exiting on strength. It's the ultimate textbook setup for an imminent decline.
Just take a look at the red downward-sloping divergence lines on this chart of the Dow. While the price structure at the top is pushing higher, the internal mechanics, represented by those downward-sloping indicators, are completely breaking down. It's like a house with a fresh coat of paint but a rotting foundation. The underpinnings are crumbling right before our eyes, despite the superficial highs.
Which brings us to part three, the specialist's sell trap. This exact market behavior is currently engineering something devastating, usually built over a 5 to 10 day sideways congestion box. Here's how it works in 3 steps. Step 1 is the setup. The market makes a marginal upside breakout, hitting new highs. Boom, this excites the public, who rush right in to buy. Step 2 is the trap itself. Because this breakout lacks true volume and range expansion, it's a false move. Actually, it's distribution taking place on strength. And finally, step 3, the trigger. Your critical watch point here is the true low of that breakout day.
If the price breaks back below that specific low within the next 1 to 3 days, the trap is sprung. The public realizes they've bought a bill of goods, and a swift, sharp decline becomes highly probable.
All right, part 4, navigating the seasonal bottom.
So, moving from the immediate danger to the overarching strategy, the source analysis points out that all of the major cycle bottoms that were previously right on point have stalled and are now moving sideways. You can see this visually represented in the flattening out of the indicators here. The market is currently undergoing some heavy distribution.
But this low-volume exhaustion phase isn't just floating around randomly. It is grinding sideways with a real purpose. It's basically burning off the remaining weak momentum. When we align these cycles, the whole thesis becomes crystal clear. We are moving sideways specifically to set up a major seasonal bottom. The analyst notes that after reviewing every major sector, with maybe 1 or 2 exceptions, they literally all look exactly like this. The goal here isn't to fight the current trap, but to survive this sideways grind so you are perfectly positioned for a major fall seasonal buying opportunity.
Which brings us to the golden rule of navigating this exact environment. Never buy strength. I'll say it again, never buy strength. A low-volume, tight-range grind into new highs is the absolute worst kind of strength to chase. You must exercise extreme patience and, as a source text bluntly puts it, wait for a hard down day.
So here are the definitive defensive rules you should take away from this explainer today. First, exercise patience. Just do not go long yet. Second, if you are already long, treat this as your blaring warning siren to tighten up your trailing stops. The precise rule provided here is to keep those stops exactly 2 points below the most recent minor swing low. And finally, if we see any short-term up day, look to take your profits and secure your capital.
I want to leave you with this final, provocative thought to force an immediate review of your own portfolio. If that 1 to 3 day trigger is hit and the specialist sell trap springs shut, are your trailing stops tight enough right now to survive it? Thank you so much for joining me for this explainer. Stay disciplined, manage your risk, and I'll see you next time.